Hey everybody, David Costello here, founder and CEO of Jetpack Workflow and host of Growing Firm Podcast. Today we have a returning guest, Brannon Poe. He is the founder of Poe Group Advisors and Accounting Practice Academy. Just about every year we love to invite him back on, talk about the state of M&A and what are some of the ways that you can succeed, whether you're planning short-term, mid-term, or long-term, to buy or sell your firm. We talked in the middle of COVID, we talked pre-COVID, now we're talking, I guess, post-COVID. Really excited to talk about what's the same, what's different, and what firms can do to really increase their valuation and so much more. But first, Brannon, welcome back to the show.
Thank you, David. Thanks for having me on. I'm glad to be here.
Yeah, absolutely. Well, I'm curious. We're in 23, of course, and what have you seen? What are the enduring things that have remained the same, whether it's 2018 or 2020 or 2023? And let's start there, and then we'll talk about some of the trends you've seen either accelerating or decreasing in momentum as we get out of COVID.
Yeah. Well, I think what's the same is either if you're buying or selling, it's a life event, and people need to do those things. So the market has some impact on those things. But, when you want to retire, when people have grandchildren, or when people have children and need bigger income, so they buy, or whether an acquisition is strategic, those things are sort of constants in our world. So people always will need to sell, and hopefully buyers. I think one trend that definitely has been noticeable on our end is the staffing challenges that is affecting the entire profession. We're definitely seeing a lot more value placed on longevity of team members.
Interesting.
We're seeing buyers are rightfully more interested in the likelihood of employees staying with the firm when they take over, the quality and experience of the staff on the firm that they're acquiring. So a little bit more emphasis there. I think that's definitely something that's different.
That's interesting. Yeah. And when you say tenured, what's kind of the threshold, even anecdotally, people might be looking at? Is like more than 2 years, more than 3 or 5? Like what starts giving people a feeling like, okay, the team's going to be around for a little bit?
I think when you see a lot of the team members 5, 7, 10-year longevity, that gives people a lot of comfort. When you see too many team members that are in that, less than a year or less than 2 years, that's evidence of higher turnover.
Yeah.
And a lot of times higher turnover is a symptom of a bigger problem within the firm. So I think that gives buyers pause.
Yeah. So does it hurt the valuation, or seemingly you would get less bids if people.
Yeah, it's hard to put a number on it or put a percentage on it to weigh how much that impacts it. But to your point, if buyers are looking at something and they get nervous and they get afraid, they're going to either withdraw from the opportunity, or they're going to be a little bit more timid with their offers. So it's really difficult to isolate factors when you're looking at value, because they're so intertwined with everything else. It's difficult to isolate and compute, but it definitely has an impact.
Yeah. So you're saying if you have a team's tenured 5 years plus, majority of team, it sounds like that's definitely become a stronger signal in today's market.
Yes.
Interesting. And I guess taking a step back, thinking about the marketplace overall, has the dynamics shifted at all in terms of, is there more buyers than sellers? Are there more sellers than buyers? Kind of how are you seeing that scale get tilted?
Well, it's interesting. So one of the things that we did last year was refine our client acceptance filter. So I don't know if you own a CPA firm and you don't have a filter to really methodically go through and examine, analyze your potential clients. We did that last year, and we said no to a lot more deals. We said no to more rural practices, and we said no to more deals that weren't cash flowing properly. So I think we saw a big jump in business. So I think overall our tightening up of our filter is a reflection of the market, because we did a big analysis on, okay, what are the practices that we sold quickly? What are the characteristics of those firms? And then in contrast, what are the characteristics of the firms that either didn't sell for whatever reason or took a long time to sell? In other words, their average days on the market was lengthy. So we did a pretty deep analysis, and what we essentially found out is like location is a big factor, cash flow to owner is a big factor. And interestingly enough, we saw a high correlation with when we looked at mix of services. So when we saw firms that had outsized proportion of, I call them orphan personal tax returns, meaning they're not associated with a business. When we saw a high number of 1040s or personal tax returns that weren't associated with a company, either if they had the bookkeeping and that personal tax return, that's not what we're talking about. We're talking about the freestanding. So we saw higher turnover rates, lower cash flow, more owner dependency. And these are broad generalizations, I realize, but it was an interesting analysis. So that impacted our filter. So we said no to a lot of deals and our sales went up.
Interesting. So location, unpack that for me a little bit. And I'm curious where remote or the virtual firms kind of fit into that.
So that's a great point. So your virtual firms are location agnostic. And so we have more buyers for those, and the multiples. We actually have a Cloud Factors pricing report now that we've published on our website to talk about our history with selling cloud firms, because we are getting higher multiples. We've got some data in that report. I think that data is we're probably going to need to refresh that pretty soon, because what we're seeing is some multiples that are pushing the envelope. So we're seeing the multiples for virtual firms is still increasing as the market gets more comfortable with those firms. And as I think there's some consolidation going on, I think there's a number of factors in the virtual space. But when you look at traditional firms in terms of location, rural areas just increasingly are challenging in the U.S. Now, we have rural practices in Canada too, and we find a little bit bigger, stronger market in rural Canada than we do in the rural U.S. in most places. But it goes back to like the number of potential buyers. So that's a really key concept when thinking about practice value, is like, how many people potentially would buy my firm? It stands to reason the more people that are willing to buy it, the higher the multiple is likely to be, the better the fit is likely to be too. So, when you have a larger universe of buyers, there's probably a couple in there that are going to be like really good fit in terms of temperament, management style, vision, all of those things that you want to evaluate when you're looking at buyers. So a major metropolitan area like Washington, D.C. or Atlanta, they're going to have a bigger pool of buyers than somebody's in a rural small town in Eastern California.
Yeah. Well, the cloud multiple, I guess, what do you see as average, and then how much above average are they?
So the data that we had from 2020, 21 to 22, when we created that report, our average, we were seeing about, if memory serves me, is only about a 15% premium for virtual. I think if we went back and did another data analysis, we would see that it's probably maybe 25, maybe even 30% higher now. We had a pretty big transaction in Canada that was almost a 2x multiple for a virtual firm. Now it was very strong. It was a very strong team, very strong cash flow processes. I mean, the processes were very well documented, followed by all. This was a machine.
That's amazing. I was curious, the cash flowing benchmarks. When you say somebody like, what is the threshold for you to take them on as a client? Then obviously somebody gets 2x, it sounds like they're much higher than that.
Yeah. So what we've done on our filter is like, if it's less than a 30% cash flow, then it gets a lower score. Now, it doesn't mean we won't take it. There could be other factors that would make the practice score higher for us, and then we would take it. But when it gets below that 30% threshold, our tendency is to say to the seller, like, look, at this point, I think it's worth X. If this is not satisfactory, then we think we can give you some advice on how to move that number up. And we're happy to try to help you move that number up so that you can position it for the market later. Or if you're not willing to do these things, and if you're not willing to do those things, that's okay. That's understandable. Then we think we should, then we think it should sell for this. So if a seller is going to be realistic about the price and be willing to sell it for what the market is likely to bear, then that can alter our acceptance filter score.
Yeah. When you see something like cash flow fall below 30%, I know it could be very contextual on the firm, but what are some of the symptoms that you typically see? Is it pricing? Is it packaging? Is it workflow? Is it all the above sometimes?
Sometimes it's all the above. It's usually one or two big things. I would say pricing is probably the biggest one I see. The other thing that I see is pretty common is a firm will try to be too many things to too many people. So if they're scattered and they're not focusing, they don't have very good focus in terms of what is their target client, what is their target industry, what is their sweet spot. Like if they'll just take anything and everything, and what's the symptom is like you see the mix of services, it's like 10 things. It's like, oh yeah, we're doing wealth management, we're doing audit, we're doing tax planning, we're doing estate work, we're doing all these things, and the firm's got 8 people in it. You can't. Now, if a firm's got 50 people in it and you've got people specializing, that's a different story. But when you have a small firm and people are trying to spread themselves too widely, it just doesn't work. That's been our experience, is the profitability tends to suffer.
I see. Well, your eyes are bigger than your mouth, and you get indigestion. I feel like a lot of firms, especially, but I mean this could be broadly applied to business overall, is more folks suffer from indigestion than starvation.
Well,
there's no lack.
It's counterintuitive though, right? Like we actually said no to more deals last year, and we did better, as a company. It's just like, that doesn't make any sense. Like you turn stuff away, but when you turn stuff away, you're able to focus on the stuff that you keep much, much better and more effectively.
Yeah. Yeah. And look, it's like you say, I mean, if you're focused on that niche that is most profitable and enjoyable to work with, then your cash flow should follow. And there's probably an 80-20 people need to think about for their client mix. So when you think about inputs, location, cash flow, you mentioned a mix of services, but you said, when you see a lot of individual tax returns not tied to a business, then that's really a red flag. I guess, was there anything else that was surprising? I know in the past we talked about something like owner time off as a proxy for like systems. Do you still think about that as an attribute? Okay.
Yeah, I see a direct correlation between success of the firm and the amount of time off that the owner can take. So owner dependency is a big aspect of success. And yes, when you make that leap, when a firm makes that leap, they need more structure. It's like when you start a firm, like let's say you start a firm from scratch, or you buy a small firm and you get going. That's a very entrepreneurial sort of run by the seat of your pants kind of phase of the business life, right? And then what happens is maybe you hire a couple of people and the business does okay. You get to about 5, 6, 7 people on a team. And what got you to that point really won't get you to the next level. And what has to happen is you have to bring in some structure. So you go from this, and we definitely see this with virtual firms, the cloud firms, because they tend to be started by more sales minded sales-focused entrepreneurial type of CPAs or
Interesting.
accountants. So that's the typical startup of a cloud firm is an entrepreneur. And they don't like structure, but it works great to get going. And they can build it up pretty fast and scale it, and they can get business. But then the operational problems start to show. And then what you need is structure so that someone can manage the firm. And that's where systems, structure all come into play. I mean, it'd be interesting to know what your sort of ideal client that you can help the most. My guess is it's probably they start hitting that $750 million mark and they can't seem to get past that without playing whack-a-mole with all the problems that they have.
Yeah, absolutely. Well, I think you definitely hit a point where, about 500,000, 750. Sometimes you get people that are a little bit more forward facing and, maybe they had used a tool at a prior firm. So they know they want to use something for their new one, but it's usually you have a couple team members, you get your staff and you're like, oh, great. The cavalry's here. And then the house just feels like it's burning even faster somehow. Like you're working harder for less margins and you're micromanaging too much and you don't like it. So you either have the choice to kind of somehow adopt a workflow muscle and kind of build that out, or kind of go back to being very small and being a very, very small boutique agency. Most people want to get to 10, 20, 15, 20, 25 people, because then you get interesting scale. And I think you get to enjoy some maybe more time off by doing so, which leads me to ask, when you see a good correlation between owner time off and a well-run firm, I guess let's quantify what's an interesting or kind of benchmark time off an owner should be taking if the firm's well run. And I think that could be a good thing for somebody to post a note in front of their office if they're listening. They're like, this is the vacation I should be taking.
Yeah.
If I'm doing everything right. So
I had a client a few years ago that we sold, and he had a wonderful firm. The revenue was, I want to say it's about 2.3 million for a one owner firm, which is a pretty good size one owner firm. And his cash flow was about 50%.
Wow.
Which is also really good at that level. And he took about 3 months off a year. So that's doing it right. I had another seller that we actually sold last year who actually did even better than that because he had 3 other companies that he ran. So he put about 5 hours a week in his practice. And that practice also was, I think he was doing maybe 1.5 million-ish. And cash flow was still at 500 or 600K a year.
Awesome.
It was less than 50%, but 5 hours a week of owner time.
And I'm assuming there's like a GM or a COO or somebody. I mean, you have to have somebody that's blocking and tackling the day to day, right? So that person's implemented in those firms.
Correct. Yes.
That's amazing. So either 5 hours a week or 3 months off a year. But if you get an intake form and somebody says 3 months off a year and the firm's not like burning down, that's a pretty strong sign, right? You get 12 weeks off a year, and you're cash flowing 50% on, whatever, 2.5 million. That's amazing. To switch gears a little bit, when you find people that maybe aren't a fit, or you see some of these red flags, I know recently you launched some coaching and consulting. I guess, as we wrap up here, and, certainly if people want to, reach out, they can. But I guess help me understand what's going on with the kind of other arm of the business that you've launched, and who do you really focus and what do you really help them with?
So our ideal client for Accounting Practice Academy is somewhat like I mentioned. They're probably around $1 million mark in revenue, team of 6, 7, 10 people, and they just can't seem to break through. They seem a little trapped. Most of them are burned out. They're tired. They're working too much. They just can't seem to get ahead of the game. That's our ideal client. That's who we can help the most. And Accounting Practice Academy, it doesn't have a heavy reliance on technology just because that's not my specialty. My focus there is really on mindsets and having very simple tools for them to figure out their strategies. We don't per se give them specific, like it's not a paint by numbers program. We want people who are willing to think and go through this journey. We have a mastermind component, and just about every mastermind does like a tech stack comparison. So they are within their own masterminds, they do deal with technology. So that's not our focus, but our focus is on pricing, delegation, pruning is a big part of it. So just like, what I mentioned that we've done, your client acceptance filter, what kind of clients are you going to take? What are you going to say no to? Because what you say no to can be as important as what you say yes to, maybe even more so. And what, a lot of people end up giving up entire segments of the business, because when you really do an analysis on some of those smaller segments, if you're spread too thinly, you're actually losing money on them. Not only is it like, okay, I think that's the hard thing about it is like on the surface, I'm bringing in $200,000 a year on this segment. Like I can't just cut that out, but you can, because CPAs are in very high demand. The work that you eliminate, you fill it back up with better stuff. I mean, that's in a nutshell is like you come in, you take a practice, you prune away what's not working, and then you double down on what is working. And then you charge a fair price for it. It's not that complicated. What's complicated is getting people to change. There's inertia just gets most people.
Yeah. Well, put that 3-month Post-it note in front of you and see if that'll help. I have one final question. You mentioned talent. I mean, we hear about this all the time. I mean, the pipeline is really challenging, certainly coming out of college. I think the workforce is really challenging. Have you worked with firms that have, do you see any momentum behind more freelance, fractional, onshore, offshore? Is this a component you see more often? Or how are firms trying to overcome like all these talent challenges that you've seen in your network?
Well, I think one thing, it's forcing them to think about what they need to prune away from their clients. I think that's probably the easiest thing to do. And that's very effective, and it's instant, right? Like if you can cut the workload, that's instant relief, because you don't know when you can hire. It might take a while to get a good candidate. I haven't seen a whole lot of accountants. It's increasing, but I haven't seen too many people offshoring, which is kind of a easy thing, especially for administrative help. Like offshoring for administrative help is kind of like a game changer. But remote work, definitely people are adopting remote work to help, because then your pool of candidates increases dramatically because you're not location tied down. If I had a rural practice somewhere in a small town and I thought about if I wanted to sell my practice, I'd convert it to a virtual firm. If you have 3 to 4 years to make that conversion and really become 100% virtual, because unfortunately there's some people in rural towns that are just not going to be able to sell their firms.
Yeah, I don't know what they do. I guess they kind of just wind it down, or they kind of give it to a family member almost to kind of run it, but there's not. Yeah, I mean, I remember even at the height, I feel like of like, maybe some of the selling behavior. It was always been challenging in rural markets, but I think especially now with whatever state the economy's in. Well, Brandon, I think we covered a lot. I'm excited to hear from the community. If you're thinking about selling your firm, or you recently bought a firm, you have some data you want to send our way of what you paid for it or what you're looking to sell it for, you could always send it my way. But Brandon, if somebody wants to reach out and connect with you, take a look at your listings. Like I always find it fun in the same way people look at home listings, kind of look at accounting firm listings on your site. What's the best way for them to connect with you?
Just go to the website at PoeGroupAdvisors.com. You can also find me on LinkedIn, and you can find me on Twitter.
Yeah, amazing. We'll get that linked up at jetpackworkflow.com/blog. That's jetpackworkflow.com/blog. We'll do a full write-up of everything we talked about today with Brannon. We're going to link up not only his sites, but maybe some of the resources you mentioned, the pricing resource and the cloud benchmarking resource. And if you enjoyed this interview, please leave a review. It helps us get the word out. And if you really loved it, if it kind of sparks some ideas of how you should be thinking about your own firm, whether it's time off or pricing or anything else, share it with a fellow firm owner that needed to hear this. I know that's the best way to say thank you for Brandon for coming on and for us for doing the show. Brandon, it's always a treat for you to come on. I look forward to the 4th or 5th or 6th. I don't know which one we're on right now, but I look forward to the next one.
Likewise, I'll have to keep it going. Thank you, David.